All right, 3, 2, 1, and we are live. Hey, friends. Ernie here with the Trader of Futures. Actually, Ernie here with Patterncast, talking about futures. Today's topic. Now, I know that my previous channel, I had literally hundreds of videos on these types of topics, so I'm going to have to try to backfill all that. But today's topic is something that happened recently, and it's a source of confusion. And here's my goal for today. My goal for today is to show you from a trader's perspective what are the mechanics, or what actually happens, and how you should react, and what you should look for, and where are the resources when it comes to trading futures that are right on the edge of expiration. All right? The other goal is to put the fear of God into you about expiration. Now, it's not entirely necessary that you get all in a bunch on some futures products. Those futures products that are cash settled. But those that are not cash settled, you damn well better know whether it's cash settled or not, or if it's settled with the actual product. Let's face it, nobody wants a phone call saying, Mr. Veritimus, where would you like the tanker of oil that we have sitting out in front of your house? That's something you don't want. Or, where do we put the lean hogs or the bushels of corn or whatever it is? Because when you have a futures contract and you allow it to go to expiration, there are obligations that you have to take delivery of the underlying commodity that it represents. And you don't want that. No, sir. Now, if it's a cash-settled product, like most of the index products, the stock market index products, like the ESE Mini or the YM, the Dow, or the NASDAQ NQ, those are cash-settled, so you don't really have to worry about it. They just do the math and figure out what you owe or don't owe, and then the contract goes away. So you don't really have to worry about that. Now, the other thing that you do have to worry about, at the very least, is to know when expiration is. And when your broker is going to allow you or not allow you to trade that as you get closer. Because different brokers have different standards. They understand that they're dealing with retail traders. They understand that not all retail traders are in their right minds or understand what they're doing. And so they put rules saying, you can't trade this right now, we're too close to expiration. Or, you must liquidate this immediately or we're going to come down like the wrath of God upon your ass. Really important. Those are important things. Important things to know. Where do you find out this information? Where do you find out when your particular futures contract expires? Now, first of all, there are essentially two different types of expiry calendar events. They usually happen on the third Friday or third Thursday of a month. They could be monthly expirations like oil, where they have a contract every single month. Or they could be quarterly. Now, the quarterly ones are always expiring in December, March, June, September. December, March, June, September. Boom, 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 boom. Every 3 months. And it's the same thing with indexes as well as currencies, foreign exchange futures, and several others. There are some futures that have kind of staggered months, like gold. So you have to understand exactly when that expiration is. Now, some people might say, yes, I do want 100 ounces of gold delivered to me. Assuming that you have about $120,000 or $130,000 immediately. And you can take delivery of a crate full of gold or silver. Imagine 5,000 ounces of silver. What are you going to do with 5,000 ounces of silver? All of that is very important. It's very important to understand when that expiration happens and what are the obligations that you have should you miss that. You should never miss it. So if you're in a futures contract, the very first thing you should ask yourself is, man, when does this thing expire? Do I have to worry about expiration? It's not a big deal. Now, you could also be in a contract and it's about to expire. That doesn't mean that you want to abandon the position. You may not care if it expires. You just don't want to be out of that position because of whatever your analysis is saying that you think it might be still going up. Well, what are your options? You got to get out of the contract. Well, you do something that is very common in terms of the futures parlance, and it's called rolling to the next contract. You get out of one or liquidate one and open a position at the exact same time on the following contract. So in the case of futures, in indexes or currencies, the current contract this past week was the June contract. If you were in the June contract on Friday and you realize, man, I got to get out of this, you're going to the September contract. Remember I said December, March, June, September. How do you do that? Well, you have to set them up in your trading platform where you're going to make that trade simultaneously because you want as little time difference in between the time you unload the current contract and load up the future contract. And you want as little time difference because, there's a fair amount of volatility in futures. If it goes against you, you may actually lose some of that position. And you don't want that. You want to be able to maintain exactly where you are. So you have it kind of an atomic operation. And all trading platforms have this capability of trading multiple contracts at one time. In Thinkorswim, there's a special trading action that's called Blast. It happens there. In TradeStation, you have a trade manager. And I'm sure in virtually every other trading platform that trades futures, they have the ability to trade more than one contract or the same contract of different expirations, different contract months, and sell one, get out of the other. Some have special facilities in it that allow you to do pairs trading. That helps. But you need to learn how to do that. It's very important. Now, there are situations that happen that might be confusing when you're trading futures that are about to hit a contract expiration, or you may be trading or charting. Let's say we're charting, and I want to use this chart that is right behind me. I'm going to make it nice and big so we can see this. This happens to be the Japanese yen, a futures contract. Let's see. Let me get my head out of the way. Here's the Japanese yen, and you can see on Thursday, like I said, usually Thursday expiration. We went from, now this is, what we're looking at is the Japanese yen here. And you can see that it appears as if the Japanese yen is gapping way up. You're in this contract, and all of a sudden you see this chart, and you're going, oh my God, I just hit the jackpot. But you really didn't. What we're looking at here is the continuous contract. What's a continuous contract? All right, let's back up a bit. Futures contracts, they become available. Let's say that we have the June 2019 Japanese yen contract. When did it become available? Well, it became available to purchase a long time ago, many, many months ago, many moons ago, maybe a year, maybe 2 years ago. believe it or not. Now, there was very little activity or demand for it, so there wasn't a lot of volume way back then. But as it came closer and closer and closer to its time period, more and more people started to get into it. Until at some point, the previous contract, the March contract, expired, and then virtually everybody moved, if they wanted to stay in that position, moved from the March contract to the June contract. And everybody unloads onto there. And you see this happening at expiration all the time. What I'd like to show you is this kind of idea happening. Well, let's take a look, seeing that we're talking about the Japanese yen. We'll go to the Japanese yen futures contract. And you can see here are the different contracts. You can see the June. Now you'll notice they're showing July and August, but nobody trades those. Let's take a look at the volume. All right, so we're right on the edge of expiration. Here's the June contract. You can see there's a relatively small amount of volume. There are people trying to get out of that contract and pile into the September contract right here. When you see something like this, the contract with the most volume is referred to as the front contract. The front contract is the contract that the vast majority, virtually everybody out in the trading world wants to be in. That's the contract that they're trading now. The lower volume ones are the ones that people are trying to get out of. All right? So forget about the July and August. You can't trade those. Only June and September. And then, of course, December and March and June and September you can see here in the future. So if I wanted to, I could buy a December 2019 contract. There's only been 3 transacted. So not many people. But you could do that. So they're available. I could buy the March 20 if I could find a way to get it. I might be able to get that. You can see that there's actually open interest in some of those future contracts. All right. How do I hold on to a position? Now, before I go on, I need to kind of back up and talk about a few other things. So here you can very clearly see volume really determines which is the front contract. You want to be in the next contract. You do not want to take you do not want to expire while in this. Although in a forex futures contract, it is cash settled, so you're not going to have any yen being deposited on your doorstep. They're simply going to do the cash equivalent in your account. So it's not like corn or oil or gold or some other type of a commodity or lumber or lean hogs. No one wants hogs on their doorstep. It's not like those. So it's not as big of a deal. So some people just let it expire and then have the broker figure out what you owe, what you don't owe, what profit or loss you have in your account. But if you wanted to hold that position exactly where you left off, now let's go to the chart again. Let's say that you're right here and you want to maintain that position. You may look at one point and then say, all of a sudden, it looks like it gapped up. This is actually a continuous contract that we're looking at, the chart. We're not mapping in this chart any specific contract. This is what's called the continuous contract. This is the broker's attempt to make it look like it's all one contract going from one expiration to the next. But you can see underneath it's actually the monthly contract. So you have the June contract here on the left of this vertical line. Then it switches over to the September contract. And the price is a lot higher. Why is that? Why is that price so much higher? What happened? Well, when you think about it, we're going from June to September. There's 3 months of time here in our minds. Remember, these are just futures contracts. We're buying into the future. So why is the value of the September contract so much higher than the June contract? Remember, they're buying this with the expectation that this price is going to be at this price at the expiration date of that September contract. Right? That's why they're buying it. They're buying some future price. Because there's maybe if you're in the business, when I say in the business, like you're a big broker or something, and you actually have yen in the bank, and you want to hedge your position. You're holding a bunch of yen, so maybe you short this contract, or for whatever other reason. So you have that contract to kind of hedge your position. You don't know what the future price is, but if it's way off into the future, the further off in the future it is, the less you know. In other words, the more risk there is. When there's more risk generally translates to higher prices. So things that are in the future, they're generally priced a lot higher. So that's why when we went from the June contract to the September contract, the price is higher. Now, did you make money right at this very point? Now, let's say that you... now, this is just the June contract here on the left, and then the continuous contract underneath. It's playing a game with both contracts at the same time. This isn't one solid contract. This is a fake contract called the continuous contract that represents the continuous priced version of the Japanese yen. If I wanted to see the Japanese yen at the June contract only, here's the Japanese yen of the June contract only. All right. Here I put in the very specific symbol reference to it, /6JM. M is the symbol for June. It's the code. It's the monthly code for June and 2019. This is the June contract. If I wanted to see the September contract, I would put in U19. U is the code for September. Here's the September contract. Now, one thing you may notice when I did this, it may have looked like the shape of this chart is pretty much the same, but the pricing is very different. Now, the continuous contract doesn't have the monthly code, the month or the yearly code, just has this. So it shows where the two kind of separate. So the continuous contract then flipped from representing it from June to September, and you see this big jump. There's actually a jump in price. We can see this on very clearly if we were to take a look at. Let's take a look at oil. Here's a good example. You'll see this concept going month to month to month to month. We'll take a look at crude oil. Quotes. So here are all the different contracts for crude oil. Here's the July contract, August, September, October, November, December. Every month is a contract. Now look at the prices. July is 52.33. August, a month later, is 52.57. A month later in September, it's 52.71, then 52.74. And you can see it's going up, up, up. At some point, it kind of levels off because there may be some expectations at this point in the industry that something's happening that would cause the pricing to go down. But in general, you'll see them go up. Another place that you can see this is in, let's take something else. Let's take interest rates. Interest rates are like treasuries, for instance. Good look at euro dollars. Here's a good example. Each month, the price is going up. Up, 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 up. And that's because as we go further out into the future, there is less certainty about price. In other words, there's more risk. More things can happen between now and then. And that represents risk. There is a premium put on risk. And the more risk there is, the higher that premium. Hence, the higher the price of the future contract, the further out it goes. All right, so that's a pretty standard concept. And that concept of things that are priced that way, that the future contracts are priced higher, is a normal situation that is in place about 75-80% of the time. And in the market, they call that Contango. That is the normal pricing of future contracts, of future prices. Contango. Every once in a while, something might happen in the present day that causes a price to spike dramatically. Yet in the future, they may not believe that whatever happened today isn't as severely affected as today. And so you may have near-term contracts like the June, July, and the August that shoot way up higher than the September, October, and November. Now we have kind of an inverted price scale because there's a temporary disruption in the market. That is called backwardation. Now, a lot of traders will look at that as an opportunity because they recognize that backwardation is something that doesn't happen very often and that eventually it will come back down to a contango situation. That's the normal situation. When that happens, the spread between the different contracts may temporarily go like this, whoop, and then they'll come back down like that. When that happens, what a trader will do is they'll take the overperforming one and short it, and the underperforming contract and go long on it, and make money as they come back to their sort of normal state, their mean state. It's not as... It sounds like it's like, it sounds like a money machine on backwardation. Well, it really isn't. You really have to know what you're doing when you're doing that. Your timing has to be right. Pricing has a way of kind of working in a lot of this knowledge. And you can't always take advantage of a backwardation and think that you're going to make money. Anyways, that's pairs trading. That's statistical arbitrage, things that are kind of probably well beyond what you're doing. What you're doing is you're just buying a contract and wondering, what the hell happens? How do I stay into a position if it's going to expire? Well, you do something called the roll. Everyone that has been trading futures for a while understands what rolling is. Rolling is nothing more than the process of liquidating the current contract and then opening a position in the future contract. It's very important that you do it at precisely the same time because, like I said before, there's a lot of volatility. You know, the contracts are doing this. So when you do it, wherever that spread is at that time, you want to get it right there, so that there is virtually no difference in the relative price. Even though it might be higher in the future, its relative price is about the same. So hence when we look at something like the Japanese yen, like this guy here, there's going to be some point here, I'll put it right in the middle here. There'll be some point where you want to exit the June yen and get into the September yen, and you want to do it at precisely the same time. Now, there'll be a big difference in terms of the price. You don't care because the margin will be about the same. The movement after you get into it let's suppose that there was no split in the contract. The movement would probably be about the same. It's just at a different price. You haven't made or lost any money by exiting this and then entering this, other than where you originally got into that contract. You might have a gain or a loss from where you originally entered. All right, but you would have had that anyways if it had just kept on going. So you get into the new contract. Now you're starting, kind of, restarting where you left off, and then relying on the market to tell you where that price is going. In this particular case, it started to go up a little bit and then went down. So overall, your position from here is a little lower. But it's continuity that you're looking for. In your analysis, you may think that it's still going to go up or go down, or whatever the case may be. All right. I don't know if this has been confusing or not, but this is a reality of futures contracts. Let's see here. Do we have some questions? People are asking me Bitcoin questions. Yes, I have a little Bitcoin, and I've made some money, and I'm going to exit before 9,800, but that's besides the point. All eyes. So when futures contracts end, typically, the price gets manipulated up? No. I hear this all the time, and they used to talk about it in Bitcoin futures, that somehow there was going to be some play at the end of a contract expiration that price is going to change dramatically. No. The prices aren't getting manipulated up. They're already up. They were up before the contract even expired. As I showed you with the oil, you can see right now all the future prices are up. They're higher. Well, that's not oil. What is that? That's the euro dollar. Same thing. All the future prices are already higher. They're not going up. At the end of expiration, you're simply jumping off that stair and going to the next stair. That's all you're doing. Any other questions here? Do you use roll yield with backwardation in any of your strategies? No, we do not do pairs trading in PatternCast. We only either buy or sell futures contracts. If we are in a situation like last week where we get into the Japanese yen and we realize that we need to get out of the Japanese yen but still maintain the position, then we will roll into the next contract for the Japanese yen. I just wanted to explain, well, what is actually happening. We're going from here to here. By getting out of this, we're ending this position with a certain P&L. And then we're getting into this position, starting with a P&L of 0. All right? You can think of it as a continuous pricing that whatever your P&L here now can get tacked onto here, because you're still basically in the same thing, but just at a different level. And it's going to move up and down like it's going to move up and down regardless of where it was before, based on what the market wants, where the market wants it to go. That relative price from here to here isn't an indication of where the market thinks the yen is, the actual yen. This is the future price of the yen, 3 months into the future. This is just a representation. It's a derivative of the yen. It's a contract used to predict the future price. You're not actually buying the actual yen. It's not like you're buying an ETF that represents the actual yen at that particular point. Or it's not like you're actually buying yen. Because yen never expire themselves, the actual physical money. Just like the physical dollar doesn't expire. Or the piece of gold, it doesn't go poof and then reappear. It doesn't all of a sudden go from worth, a gold coin go from $1,200 to $1,300. Just the future price of the contract may go up there with the anticipation that it might be at a higher price. Options do have this phenomenon. So, as a matter of fact, options absolutely have this phenomenon. It's the exact same phenomenon on options as well. Virtually every option contract price is priced higher than the previous contracts. Any other questions here that are worth noting? Probably not. All right, so I think I've covered this pretty well. It's important that you know where to find this information. For most futures that we deal with, they are under the CME exchange. So go to the cmegroup.com under trading, and then you can get to the different product categories. For others like cocoa, coffee, and cotton, and rough rice, and others, they are on the ICE exchange. So you can go to theice.com to agriculture and softs. And then you can find out the information about those contracts there. Orange juice. We love orange juice. So now you know where to find it. You should understand exactly what it means to go from one contract to another. One contract expires, the new one kind of takes over. It already exists, but that other contract that expired goes away. So you have to go somewhere, so you might as well roll into that next contract. When you do that roll, all the traders in the world are also trying to time that because they may want to also maintain their position, so they liquidate one and then pick up the other at the same time. They do that transaction at exactly the same time. They set it up in their platform to do that. Hey, Larry says, I don't understand why there would be more risk when the yen, the other dollar in the future. Isn't it more a matter of interest rate difference? Even interest rates in the future are priced higher. And longer interest rates are priced higher than shorter interest rates. So in other words, whether you understand it or not, the simplest way to look at it is anything that's further away is considered more risky because there's more time for stuff to happen. So therefore, the normal situation, 75 to 80% of the time, is to price it higher. And that's just the way it is in the market. Whether you understand it or not, you got to come to grips with that. That is the fact. That 75% of the time, markets are going to be in Contango, meaning that future prices will be priced higher than current prices. Period. End of story. Same thing for futures. Same thing for options. Same thing for interest rates. When you hear about the yield curve, they talk about a yield curve that is steepening as being a very healthy yield curve. And every once in a while it flattens where short-term interest rates start getting up to where long-term interest rates are. And sometimes they get inverted. That's called backwardation. Those are unusual situations that the market doesn't like. It wants to go back. So this happens in all kinds of markets. Interest rates, oil, gold, indexes, currencies, everything. If it's off into the future, there's unknown. Unknown means risk. Risk means there's a premium on that risk. Premium means higher prices. End of story, period. That's the way it is. Hasta la vista, baby. We are done. If you have questions, put them down below. I will answer them in the comments. Other than that, we'll see you next video. Thank you very much for showing up. Really appreciate it. Bye.